Well, we've had a Fed policy announcement. It did stuff. Markets wiggled this way and wiggled that way, but ultimately no change in policy. And what I've been describing as strategic vagueness in the messaging, we'll get into that in just a moment. And of course, the big question for markets, as ever, what's next after all of this, and what does it mean? That's what we're going to tackle here on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive, and we're just going to jump right into it. We'll unpack what the Fed did and said here, which was not much, but perhaps that is a message unto itself, and then take a look at another central bank that is waiting in the wings here to rattle markets in just a matter of hours. So first up, of course, just to look at the S&P 500 here in the wake of this Fed policy announcement. We can see from the price action, the markets were somewhat heartened, having been on the downside going into this meeting Monday and Tuesday, pulling back from this barrier here around 57.24, this kind of inflection point right here. And very tellingly, as we discussed on the show yesterday, also the spot right before that Liberation Day gap that gave us all of the consternation that was the month of April. So we've reset all the way, and we're back to where we landed when growth concerns about the U.S. economy started to take this market down from about mid to late February into mid-March. We paused to digest. Of course, then we had the scare. We're off the scare and back to where we paused to digest. And so the question is that of growth, and the Fed seemingly telling markets today that it doesn't know what to do next because it doesn't know whether to prioritize growth or inflation, and that rates are well positioned to act either way when that clarity emerges. When it will emerge, who knows? And the uncertainty means that they're not going to do much of anything for now. The markets cautiously off toward their lows for the session once the announcement hits, then back up because they don't find enough conviction to make lasting progress. However, when you look at the bond market, what you do see is a little bit of a pull up here at the long end, ostensibly around this idea that if the Fed is going to delay rate cuts now, it'll have to cut more later. So you get a little bit lower yields and higher bonds at the long end of the curve. The U.S. dollar here doing next to nothing. This is the dollar index, and it is firmly confined within a range. The dollar a little bit higher against assorted currencies, but not really going very far at all. Basically stuck within the ranges where it has been oscillating recently. There's a little bit more vigor on the yen, perhaps a little bit less on the Australian dollar, and really as you look across markets, you end up with the kind of goose egg of a response that we're seeing right here. So just a touch higher, but ultimately going no place far. Here's the Fed's statement and the changes in the communication. We, of course, noted the impacts of trade in distorting GDP data, and the Fed leads with that here. Just to quickly give a sense, here is that distortion. Obviously, we can see a giant jump in imports and then a surge in investment around building inventories, all of that, the front running of tariffs. And the Fed very clearly name checks that right from the get-go, says that uncertainty about the economic outlook has increased further, ostensibly since March. And the Fed judges that the risks of higher unemployment and higher inflation have risen. In other words, risks pushing the Fed's objectives in opposite directions have risen. And this, of course, lines up exactly with what the Fed gave us in March, the last time it updated its economic growth expectations. We can see they went from from faster growth to slower, from lower inflation to higher. Didn't change anything on rates, though, basically reasoning we don't know which way to jump. Our objectives are at odds. There's no imminent reason for us to jump necessarily. We're going to wait and see. And that's basically what today's rate decision boils down to. If we can see here the expected rates path going forward, we have one cut at minimum on the board by September. It is almost certainly at this point slated for July, but doesn't appear in July in the quote because of technical reasons. The meeting is on July 30th. So indeed, for most of the month of July, there is no cut. But by the time you get to September, of course, that cut is already priced in, and there's no meeting in August. So in July, there is a cut. We further see cuts in October, again, going into November. That's a very late meeting, and then in December as well. So we end up with 3 cuts, essentially, on the board here, starting in the second half of the year. That much has not changed very much here. The path has become a little bit actually stickier at the front end of this year's curve as relative to March and January. We can see the Fed is actually expected to hold off on cutting a little bit longer. There was a much smoother glide path here, and that glide path favored actually higher rates but sooner cuts as the year progresses. And here we're looking for a longer delay but then a faster decline into a lower level. And that's, of course, exactly what the rise at the long end seems to kind of echo, this idea that there will be a delay, and while this dithering means rates will be held higher longer, it also means that they will be cut sharper later. You see in the outlook also sort of where this kind of hard neutral stance from the Fed ends up as a kind of inflating of the outlook for next year, if only modestly. We've added about 9 basis points from yesterday to today into the cumulative cutting cycle from this year through the end of 2026. We can see that wiggle in the orange cumulative line here. We also see that the Fed is holding to this hard neutral stance, and that of course implies, as we can see from here, 50 basis points apiece this year and next. So from this 4.4 here down to 3.9, that's 50 basis points, then down to 3.4, that's 100 basis points. The markets are, again, a little bit to the dovish side of that now after the policy announcement. Moreover, they don't want 2 cuts this year, they want 3, with at least 1 more in 2026. And that, of course, is a little bit more dovish. So on balance, this announcement is a bit to the dovish side for markets because they ostensibly expect more to need to be done later. But as far as sort of where the Fed is positioned, although there isn't much delta in between where the markets are at 109 basis points and where the Fed is at 100, the markets wanted this to happen faster. And so there is perhaps some level of disappointment here, although we can see from the reaction in the S&P that disappointment is mild at best, at least so far. Now, from the Fed's perspective, they're saying we just don't know what to do with inflation expectations. And to that end, we can see that although core inflation started to slow in the most recent set of numbers in March, we also only have about 1 month's worth of cooling in these higher frequency 3-month and 6-month annualized rates. Recall that at the beginning of last year, this is a similar thing that was happening, and the Fed resisted rate cuts that the markets were calling for from about April all the way until September. So it had to see all of this cool down from this pop in inflation dynamics, and We're very early into something like that. So the on-ramp here for rate cuts looking relatively long. And interestingly enough, the markets seem to have called already for what is likely to be needed at this point. We can see here, this is inflation expectations priced into bond markets. They're suggesting that inflation is going to end up lower, not higher, downwind, and that's because whatever economic downturn comes as a consequence of the tariffs will so thoroughly pummel demand that any one-off price increase from the consumption tax that is a tariff, which just an extra sales tax on particularly imported goods, what price increase that will come from that will be more than overwhelmed and more than subsumed in disinflationary pressure from the recession that those tariffs cause. And so with that in mind, the market is already saying to the Fed, look, you don't have to worry about inflation expectations. You can just cut. And we want 3 cuts, and we want them to start sooner. Let's go. And what the Fed is saying is, yeah, we are not going to make that call here, especially given the political pressure that we're under and given the sort of uneven nature of the data. We can, and Powell said this repeatedly today, along with the markets, see very clearly that the survey data is awful. We can see in the PMIs, growth has stalled to near standstill, whether you look at S&P Global, where it's a little bit better on manufacturing data, a little bit worse on services, or ISM, where it's a little bit better on services, a little bit worse on manufacturing. Either way, the midline here falls a touch above the midpoint of 50, meaning the economy has gone to basically standstill mode, just a touch better. We've already seen the distortion in GDP. It was a negative number, but all of this fuzz here obscures it. We saw a slightly better than expected NFP number, but the 47K by which this outperformed is almost completely undone by the 48K downward by which the prior month's numbers were revised. So there's not a clear read from the hard data here as far as the Fed is concerned for them to unequivocally and beyond reproach justify rate cuts, even though the market is already screaming at them that the time has come. And for this reason, the drill down bottom line here may well be disappointing for stocks, because all of what they are seeing in the survey data, they've already made up their mind about. But the Fed isn't giving them the hopeful sheen of future rate cuts to feel like they can weather what may well be a sort of garden variety mild recession. And with the fog so thick, they may well opt to back away from risk taking. But that is certainly not how this has played out so far, at least in the immediate aftermath. And this is where things get especially interesting, because we get a very different kind of view, but on all of the same dynamics across the Atlantic from the Bank of England. Now here, we are fully expecting that we are going to see a cut from 4.5% to 4.25% fully baked in. And we can see that, moreover, there's further easing here expected. In fact, for the year, we're looking at almost a full 100 basis points baked in. We can see from 4.5 to essentially 3.5, the 3 basis point round off there, but that's not really anything to quibble at. The chances here are exceedingly high. So you get from 4.5 to 4.25 here. That's one cut. By August, you already have a second. By November, you've already had a third. And by December, you've almost certainly had a fourth. So a very kind of clearly negative path for rates, and a view that has become increasingly dovish since the beginning of the year. The view for February and March, we can see here, was a little bit better. In fact, we'd actually seen a little bit of a hawkish shift from February into March, but obviously that has since fallen away. Looking beyond this week, we can see the markets pricing in 84 basis points in further easing. So again, leaning to 3 more cuts this year after this one, and then about a 50-50 shot at a 5th cut next year. Now, this, of course, lines up with terrible economic data recently out of the UK. We can see the economy has actually moved into contraction mode. And although it had been hovering near standstill basically since the end of last year, what we see is that now, while manufacturing has been anemic, services was holding it up. And as with most developed economies, services is a bigger piece of the pie. So despite the fact that manufacturing has been shrinking now for 7 consecutive months, that would be readings sub 50 in the logic of PMIs, it is nevertheless being or was being offset by services over the preceding 6 months, and over this last 7th one in the sequence in April, services actually fell below that 50 level as well to 49, and so we now have contraction across the whole of the economy. And we're back into sort of recessionary-like conditions in the UK. On the inflation side of things, things are looking like things are beginning to cool off again. We can see headline inflation coming down to 2.6%. That's a significant improvement here over recent data. The last time that we were at 2.6% was back in November of last year. So this is a 4-month low on headline inflation. The number for core down to 3.4%. That's the lowest since December of last year. So a little bit of an unwinding here, but actually the internals of the numbers making them look more supportive still, because you're seeing a broadening of disinflation. So these categories, of course, were already relatively low. Clothing, barely a rounding error, where inflation got slightly positive from a slightly negative contribution. But the biggest items on the board here, recreation and hospitality. These have been sticky parts of the inflation puzzle for the UK for a long time. And what we've seen here now is they're finally showing some real disinflationary vigor, suggesting that maybe, perhaps, UK inflation is finally unclenching and is going to give the Bank of England what it needs to cut with all of the aggression that is being implied right here. But this then is the key. If with the Fed we are waiting for hard data to get the Fed to start moving, and the markets want the Fed to start moving, and are screaming at it that it needs to have more urgency, well, then there seems to be plenty of urgency for the Bank of England. We know why they want to cut. We know that the markets think they're going to cut a bunch more. We have all the evidence that we need. And that's before we take into account all of the most recent activity around tariffs, around sort of evidence that the U.S. is slowing, and the idea that without the U.S., anemic Europe and anemic China, the other two major engines of global growth, really don't have what it takes to hold back a global recession. If the U.S. slows, then global growth doesn't have much of a leg to stand on. So there's lots more economic negativity than just sort of the idiosyncratic issues in the UK. No doubt the Bank of England will have to wrestle with them. But with all of the evidence already on the table, there may not be anything else for them to pull out of their bag to mollify markets. They are already expected to cut 4 times this year. The data is already signaling as much, and the markets agree. So there isn't much else that the Bank of England can signal that it needs or can justify doing. And so, although on one hand, you have the Fed saying, we don't have what we need to do more, so we're going to do nothing, the Bank of England is lining up to say, we're about set to do everything that we're going to do, and there's nothing new or more supportive that we're going to tell you. And so while one central bank is very much intent on action and the other one apparently is not, the upshot from both seems to be global growth is slowing and there is nothing extra beyond what is already priced in that we're going to do about it now. And of course, with no great help coming from the fiscal side, really anywhere one might look, perhaps maybe the situation in the Eurozone gets a little bit peppier from that perspective, and by extension in the UK, as more spending on defense is done amid concerns around the viability of all of the NATO allies and their willingness to come to each other's aid. Certainly a lot more questions around just how reliable the U.S. security blanket is in the current environment. So maybe that spending, as has been expected, really gives a big push to European growth next year. But with German Chancellor Friedrich Merz barely getting through procedural hurdles to take his post, there is perhaps a harder slog in that direction, or at least the appearance of one here near term. And for now, it looks like what we have is impenetrably anemic European growth. China that just rounded off its 8th consecutive quarter of economy-wide deflation and hasn't really grown since before we had a reopening from COVID. It's grown in sort of basic terms, but the economy hasn't gone anywhere. Demand is receding. The kind of growth that China needs to push the economy forward, as opposed to backslide, is nowhere on the menu. And the U.S. really was the only game in town. With the U.S. now, at least looking at the survey data, edging to standstill, and the one bit of these GDP numbers that's sort of the most clear-cut is the weakest household consumption in almost 2 years, going back to the second quarter of 2023. That, of course, is close to 70% of GDP. And all of this fuzz aside, this is the part that matters. This is where GDP is really decided. All of that suggesting the U.S. economy is slowing, and thereby the globe facing a significant recession risk altogether and all at the same time. The upshot from yet another central bank is, well, we're not going to give you any more. There is nothing else to give you. We've done all that we are prepared to commit to doing, or at least we've laid out all that we're prepared to commit to doing. And that's the message from both of these central banks. And the upshot, then, is anything but encouraging for stock markets, which want for there to be stimulus to make them believe that they can weather the near-term downturn. Probably supportive for bonds, where inaction now and an unwillingness to dial it up now across central banks. probably means lower interest rates downwind because more rate cuts have to come and with greater vigor once the pain really starts to be indisputable. That is macro money for today. As ever, we are here right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go from there. I am likewise on with Chris for Futures Power Hour Mondays and Fridays, on with Victor Jones on Tuesdays for The Price of Truth. Chris, incidentally, will be there today in just 30 minutes time, so check that out for a deep discussion of what the Fed means and where the puck is sailing from here. I'm likewise on with Victor for First Call alongside Tom on Sundays, writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Happy trading.